All right, hello traders. James Stanley with StoneX and FOREX.com. It's Friday, August 14th. It's a Friday, so last opening bell for the week. And Mr. Michael Boutros will be back with you next week. But we have a lot to recap from the week that we're finishing right now, and where we're at with a lot of these big macro trends. We had an abysmal retail sales print earlier this morning, and there was an initial reaction through FX markets. It's pared back a bit, but I think that these items, these data points, could be really helpful in trying to see what matters most in the big picture. What those major items are that markets are looking for, that they're harping on, that they're really kind of basing what might be around that next corner on. And we've seen rate expectations abate, rate hike expectations abate a bit. So a lot to look at here. This is the risk disclaimer. Please review that. Pause the video, take more time to review that if you so need. We're going to get onto the chart and start taking a look. So here's USD. Like I said, there was a lot going on this week, but if you look at the USD weekly candle, and there's still some time to go, we're at a doji. It went up for a resistance test. It got swatted back down pretty hard, and we're roughly flat so far in the week. Now, again, there is some time for this to shift into the end of the week, and there is still, I think, a pretty major factor at play. Of course, it's the dollar-yen carry trade. And I think at this point, it's now 2 weeks since the intervention. I think it's one of those things where people are going to get tired of hearing about it because there hasn't really been a lot that's happened in that story since the intervention. We've had a pullback, and well, that's still what I think to be as the major driver behind USD flows. Now, there is a possible breakout setup brewing in Eurodollar right now, but cable, Aussie dollar, they both have, I think, pretty clean backdrops for USD weakness. In the dollar itself, I have this chart. It's a little bit shorter term. This is one that I've been following. It's a support zone that came into play 2 weeks ago and has since helped to hold the lows. Big spot here from like 99.51 up to around 99.17, 99.18 up to 99.51. And you'll notice this is the spot that bears just have not been able to get below. Now, with the dollar, it needs to be considered that this isn't just something trading in a vacuum. It's a composite of underlying currencies. And so, it's 57.6% euro, 13.6% Japanese yen. It's got some CAD, it's got GBP, has smaller allocations. But, the reality is this is going to be based primarily on what's happening in those underlying currencies in the dollar basket. And I'm of the contention that even though the Japanese yen is only 13.6% of this thing, that it's swinging a much, much bigger weight. And I think one of the reasons that we have not seen more of a full-scale breakdown from that support is because we haven't seen a larger unwind in that dollar-yen carry trade. And you can't blame Japanese officials for not trying, because they did. But let's just go ahead and get over to dollar-yen. So in dollar yen, we had that intervention 2 weeks ago. It was a massive move over a couple of days. We even had some extension into the next week, but it was, like I said in that weekend video, at a 155 or around a 155, it's actually kind of a compelling long setup because the carry's still positive to the long side of the pair. It's not like the BOJ was going to intervene after a 900 pip reversal. They don't want to waste dry powder if they don't have to. And so, you get those, I don't want to call them weak hands, but you get those that are holding tight stops or tight risk levels, you get them washed out. And so pretty much anybody that wanted to bail on the trade had. And we get down closer to the support, it becomes a compelling long setup. And that's kind of been what we've had over the past 2 weeks. And you'll notice it's been that slow and stodgy, higher high, higher low type of relationship. Now, the thesis that I brought out a couple of weeks ago is that this is going to be more based on weak or negative US data. And the grounding point for that thesis goes all the way back into what happened in 2022. In that the BOJ was trying to quell yen weakness at the time. They initially tried to step in at 145 and failed. Same story as today. The carry's positive to the long side of the pair. There's still incentive for buyers to jump in, especially on a pullback to support. still like that natural motivation, and then they go up and they test the next level. And then when they get above 150 and the BOJ hasn't, or excuse me, 145 at that point, and the BOJ hasn't intervened, it's like, okay, we're going to go for the gusto, run up to 150, and it gets above, you notice the move slows as we get to 150, we get above 150, and it's like, all right, they're not going to intervene there. Let's see how far we can take it. It ran all the way up to 150, 195, at which point the BOJ had to step in again. And, I think what you could see from this, what you could take away is that an intervention is not an ideal thing for the BOJ, because they have to waste finite capital reserves to bid down the rate that their own monetary policy is encouraging. And in many cases, they'll fail, like they did here. Now, the one at 151.95, it merely pushed bulls back, right? There was still that latent buying pressure from support at prior resistance, right around that 145-ish area. Notice as we got closer to 150, buyers would shy away because there was that theoretical cap on upside. They didn't want to retest that thesis. But what finally drove the reversal was slower than expected US CPI data. Headline came in at 7.1% on November 10th, 2022, core at 6.3%, both well elevated, but they were below expected, below the prior month's print. And this finally gave the idea that maybe the Fed had a handle on things. And so this is a great illustration. It's a great lesson that fundamentals aren't that perfect push point for price. That's positioning. And if you have a crowded trade and all of a sudden you have a hint or whiff of change, and there's a reason for some of those longs to close, well, it could trigger stops on other longs, and it could lead to a counter trend backdrop, which is precisely what we had for the next 2 months. But throughout, the carry has remained tilted to the long side of the pair. And then of more recent, there's been a couple of jolts here. So like last October, we had the Senate Takeichi election. That's what finally got the pair back above that 150 level, on its way above 155 even. And then coming into this year, we had the prospect of higher inflation in the US. And more recently, especially around June, we started to see the pricing in of US rate hikes, which have softened a bit. But the pricing in of US rate hikes. And meanwhile, if we look at Japan's situation, this is a chart. This is Japanese CPI. And behind it, let me see if I can get this a little bit larger. There we go. Okay, so this is Japanese CPI releases since January of 2021. And behind, in black, I have Japanese rate hikes, right? And you can see the Japanese CPI, headline CPI, got above 4% back in 2022. They did not hike. This is when the Fed was hiking those 75 bip clips. This is one of the reasons the dollar yen was parabolic. Like, who wanted to hold the yen if the BOJ is not going to hike in response to 4% inflation? That's currency debasement. Now, they did inevitably hike, a small hike here in 2024, and then again in 2024, and then again in I believe this is December of 2024, December 2024, January 2025, around that area. But this one, last December, BOJ goes for a 25 bip hike. Inflation falls below 2%. It's remained below 2%. They hiked in June, and inflation's actually went up. But as we look at it right now, the most recent Japanese CPI print was 1.7%. Their mandate is for 2% inflation. There's little motivation for them to hike rates from a policy perspective. And that's one of the reasons this yen weakness has been so incredibly persistent. If the BOJ does hike rates, it essentially seems as though they're trying to institute US monetary policy. There isn't a need for rate hikes given their inflation backdrop right now. The one reason to do that would be to quell yen weakness. And that's a difficult argument to make. And now, what is important on this week, we had the circulating rumor that the BOJ will go for another rate hike in September. It's one of those those leaky non-leaks, right? Where somebody from the BOJ wanted to see what the market response would be, and it was lackluster. As we essentially just saw the price toe up towards that 160 level. What ultimately brought this back today was that abysmal retail sales print. And that retail sales print out of the US at negative 0.6% month over month, that was the lowest read in that indicator since June of 2025. Now, the thing about retail sales that makes it attractive, it's kind of like NFP in that it's an early look at the most recently completed month. The downside of that is it's dirty, as in the data could be noisy, it be subject to revision. It's not, it's not something that's as consistent because it does have that early nature. But we're still in that backdrop where I think it's going to be more related to either uh, strong surprises in Japanese inflation or weakening US data, pricing out US rate hikes that ultimately bring on a picture that could be resemblant of what we had back in 2022, November of 2022, right there, or November of 2023. Same story. CPI well above the Fed's 2% target, but it was lower than expected. It gave the idea that maybe the Fed's getting a handle on things. July of 2024, that was a good episode because this is when markets finally got the idea that the Fed would be able to cut rates that year. Also, a Japanese yen intervention. But it's what happened right in here that I think informs of what's been happening lately, which is in April. This is another CPI print, April 10th, 2024. This was above expected. This had, at the time had dashed hopes that the Fed would be able to cut rates later that year. And you see the stop setting above that 151.95 level that was the high in 22 and the high in 23. That was just rocket fuel for the breakout until the BOJ ultimately had to scream uncle again at 160. So an intervention at 155 or maybe even at 160, it doesn't seem like an ideal scenario for the BOJ. They obviously don't want to do this unless they absolutely have to. And the reason they did in July is because if you look at the initial response to the FOMC rate decision, which is right in here, it was just a quick pullback. I think it was obvious that Warsh does not want to hike rates if he doesn't have to. And so we had this quick wick of USD weakness. And that USD weakness showed more prominently elsewhere, by the way, which we're going to look at in a moment. But bulls just got right back on it. And it was like the overnight session when the BOJ was like, all right, we got to finally do something about this. And they intervened. But what really made that one run is when the US Treasury started talking with a rate check the following morning. And then the next morning, that Friday, when they were calling around banks saying, hey, we might actually do something here. So be ready. And that's what ultimately freaked markets out. It was the U.S. participation in that theme showing that both economies want to see that spot rate lower. So for now, it's a cat and mouse game. You get a pullback to support, pretty compelling risk reward setup to look for the fundamental divergence in the pair to play out. We get up towards some of these resistance levels, it becomes a little bit dicier, but I don't know that 160 is necessarily going to be that hard line in the sand. I think if it is, it's going to have to come from something on the U.S. side of the equation. But ultimately, this is a crowded trade that could lead to a crowded exit. So if you are playing the long side of this cat and mouse game, you got to be aware that the guillotine might hit at some point. Maybe it's below expected U.S. data. Maybe it's another circulating rumor, kind of like the BOJ tried to float this week, which didn't really help. Or maybe it's higher than expected Japanese inflation data, something along those lines. But this, I think, is still the pace setter for the dollar. I think this is still what's going to drive FX markets. Even for the euro, euro's 57.6% of that dollar basket. But when you look at how elevated dollar yen still is, it's like more than 50% above those early 2021 values. This is still a crowded, heavy, long side trade. And if you get just some of that trade whittling down, then that dollar weakness could show across the board against the euro, against the Aussie, against British pounds, et cetera, et cetera, et cetera. But this is still the pace setter, and it's high intrigue. I mean, I'll be honest, as a trader, I don't love these situations because they're highly subjective, and it's based on how the wind is flowing. But what I do like is how I could take the dynamics of this and I could extrapolate it elsewhere. And as a good case in point, kind of like I've been doing of late, the euro. So the euro's at fresh highs. I got to test in this at a big spot of resistance right now, that 115.76 level that held the highs last week. But when you look at the euro and the way this responded after that Fed meeting, right? We had this. Well, let's even take a step back to ECB. ECB the week before, right here, we had a bearish engulf that nullified a bear flag or broke a bear flag formation, right? So open door for sellers to go for a run after ECB last month. They had zero interest in doing so. A little bit of follow through that Friday, but notice we just stalled right there just inside of 114 and ultimately began to pull back. This was the day before the Fed, the week after. Now, what happened there is we built a falling wedge formation. So we broke the bear flag, did not get extension, had it with a bearish engulf, did not run. So failure from sellers. And then it bruised up this bullish reversal formation. That broke out in a big way on Fed day. And, again, notice that that's the Fed day 4-hour candle and euro dollar. Massive, strong breakout. Look at the Fed day 4-hour candle in dollar yen. It was right here, 1 p.m. on that Wednesday. Very small, just pull back to support, right? What finally changed this or shifted it a bit was that intervention. That's what is still kind of dominating matters. But you look at euro dollar, and this broke out with gusto at that FOMC rate decision. Initial move up to resistance, pullback, higher low support, and it just continued to rally. Now, when I looked at this earlier this week, it was in kind of a quiet, calmish sort of state. But when you get a range like we had, I think you have to bias that to prior trend side direction, because you have longs that had loaded up or added, and they're not taking greater advantage of the opportunity by taking profits off the table. And so yesterday we had the support test right at that same zone I've been tracking, 115 up to 115.15, and bulls are now going for the next breakout. So, I think this would be a more attractive way of trying to play dollar weakness at the moment than essentially trying to fight short-term counter trend against dollar yen. If we do get a dollar yen breakdown, I'm of the mind that euro dollar is going to follow that as well. And, again, very similar, because you could look at what happened on Friday, or excuse me, on Thursday, when the BOJ did intervene, right? So that's the FOMC bar 2 weeks ago. That's the day after when the BOJ intervened. Nothing great was happening for Europe. This wasn't like a long euro setup. This was dollar weakness, deductively coming from that crowded long-term dollar yen trade. And that's what ultimately helped to propel this into breakout. And so I think there's still a lot of overlay there in that larger dollar yen trade that could play through in euro dollar. It's just, I don't think it'll be as, like, let's say that there was an absolute breakdown in dollar yen early next week. I don't think it's going to be as large in euro dollar, but I think that the trade-off in that is it might be cleaner from a technical perspective, kind of like we've seen. These are that resistance zone is the same one I've had on my chart for a couple of weeks now, and I've been calling this a decision point. If we finally get bulls above that, sellers fail to run with that open door, and the bullish reversal is taking hold at that point. That said, I still think that cable is perhaps maybe even a little bit cleaner on the long side of the dollar, or excuse me, on the short side of the dollar, as a long against dollar shorts. And next week we do get some British data. We get some CPI. And for the calendar next week, I'm going to get to dollar CAD a little later, but for the calendar next week, there's a heavy UK focus, and so I don't try to predict these prints, but what I'll try to do is I'll try to get general trend and see if the way that data hits can help assist with that trend. And like right now we're at fresh highs. And as a case in point as to why I think this is a cleaner short USD setup, we could even do the relative comp, right? We had this swing high a month ago, like middle of July. We're right back to challenging that high. You look at euro dollar and where we're at, just from a composition perspective, you could still make the argument, especially on the weekly, that we're testing lower high resistance, right? It hasn't really been as convincing of a run, even though the past month has been a little bit more positive. There's where we were July 15th. But going over to cable, kind of like I shared in the Monday session, my qualm here is the difficulty that the pair has traditionally had over the 135 handle, which it's now showing a much more convincing run above. And you can see it was all week this week where it was fighting to stay above 135. We had this nice little clean pullback, 134.84, and that ultimately is where support played right at prior resistance, and now it's going for the breakout. But there was an ascending triangle in here. Higher lows going with that horizontal resistance that's now getting taken out. I still like this one a bit better for a USD weakness than what I have in euro dollar, but I think both are attractive on that front. Aussie dollar, similar setup. When I looked at this after RBA earlier in the week, there was a couple of different things going on there. And I had even said as much, where I thought that the bigger driver for this pair was going to be US CPI and PPI this week, which I think ultimately has played out. Now, that said, I think it was Wednesday, I looked at a reversal setup in the pair because we had ran right up to the top of this resistance zone. I was doing this off of 30. As I shared then, I mean, we were at fresh high, so it wasn't the time to, I think, try to call a perfect top. But you can see where it unfurled pretty well and made a run down towards the 70 handle, which has since recovered, and now we're right back up towards that resistance zone, and it's working on fresh. I think theoretically we have a fresh 2-month high at this point, albeit barely. But yeah, very similar story where this is something that I think is more attractive for USD weakness setups to play out at this point. Chasing this into the end of the into a weekend, into the end of the week. I think is at least somewhat challenging. But you can use these time frames to your benefit to essentially look for a pullback to play some support or prior resistance. So like this spot right here, like 70.65. Again, it's something I had on my chart earlier this week. And you can see where it's shown multiple doses of resistance, hasn't really yet shown much for support. So if we get some profit taking in this rally, in this breakout, whether it's into the end of this week, into early next week, whatever, that's a line in the sand that clearly has mattered on the way up. It hasn't so far mattered for pullback setups. But I think about the best we could do on that is, take a step back, look at the levels that have played so far, and then try to implement an if-then statement. But the reaction to that resistance on Wednesday gave a pretty adequate pullback, which buyers responded to with gusto and are pushing right back up to fresh highs. So I don't want to chase a fresh break. I don't want to chase a well-developed move, but there's a trend in there, and if we do get that USD weakness continuing, then there's something I think that could be pretty attractive off of that. And so collectively, we looked at euro dollar, pound dollar, Aussie dollar. They all seem to have this USD weakness bias at the moment. So I think it deserves taking a step back to look at why. Well, we have basically had support holding up, and prices pulled back and found sellers and got slammed back down. But what will it take for USD strength to prod a larger reversal here? Again, I think it goes right back to dollar yen. For USD strength to prod a larger reversal, I think we not only need to see dollar yen to 160, I think we need to see it beyond 160. So essentially, this would be expecting the BOJ and the US Treasury Department to be waving the white flag, which is not impossible, but at this point, I would consider that a lower probability outcome. Now, you always want to play devil's advocate on these kind of things. What ultimately would cause Scott Bessent to take a step back? Now, first off, you got to look at the fact that he's very widely communicated what he wanted, that he wanted to see dollar yen down, right? You had the incident that weekend, so there's Thursday. That was the BOJ intervention, the first rate check. That's Friday. That's when the Treasury Department asked the New York Fed to call around to member banks and warn, hey, we might do something later. But right in here on Monday, that weekend, there was a circulating picture from Scott Bessent. He was at a media engagement, and he had walked away from his desk, and on that desk was to do buy Japanese yen. I believe the number was 5 to 10 billion. And is obvious what he wanted to do, right? It wasn't a mistake. He wanted the media talking about the fact that he wanted the U.S. Treasury Department to be buying Japanese yen. So it was very, very public, very obvious. Now, the next week, there were some media reports. Nick Timiraos from the Wall Street Journal specifically had questioned how the U.S. Treasury was funding that. And they were using, or as Timiraos insinuated, they were misusing a fund that was set aside for COVID. And Bessent didn't seem to like that. He then said that Nick Timiraos was a stenographer that depends on backroom gossip to produce stories about the Fed. A very harshly worded comment towards the reporter that initially came out with that. So, I mean, there's high intrigue on that front. But for this to go back up, for this to break 160 and then rally, you would think the Bessent would essentially need to back down in a very public manner, which I don't think you would want to do. And so that's why I think dollar strength becomes more of a difficult bias to justify as anything more than short term. So we get a rally up to resistance, pretty attractive time to, take a shot on shorts, which is precisely what we saw happening this week off of that resistance after that test just above the 100 handle in DXY. But that's what I have in the dollar. Oh, yep, one last one because we have a BOC rate decision, and this is one that did not work. So I was trying to find some element of capitulation in dollar CAD this week. Didn't really show. The reason I wanted to see some capitulation is because usually when we get the 140 break, there's often at least a check back to that, and you can see obviously that is not playing. We had a bit of stalling above 139, and it's selling off right now. And on the daily, we're veering into oversold territory. Now, RSI doesn't confirm until you got the daily close, so we're not there yet. But you'll see right now that value on RSI, we're at 28.71. So if we do close at current levels, if we don't get a sizable pullback into the close, then this is going to close in oversold territory. Tough area to try to chase the trend lower. So Again, that I think that long dollar stance is difficult to justify from a variety of perspectives, and here included. But this is maybe one area where chasing dollar weakness isn't as attractive because it's had that Canadian dollar strength to go along with it. But that 139 level, it's pretty big, and the fact we're below there on a Friday and that it's just continued to fall since the 140 break without so much as a check back, that's I think enough to be you know cautious if you're looking to fade the move, and if looking to run with the move. Chasing oversold is a difficult prospect, especially on a daily chart. But that's what I have on the FX front. Gold. So this is one that I follow pretty heavily, pretty closely, and I did a video for StoneX on this one, and well, a couple videos for StoneX on this one, and so far the setup has just played really cleanly. We you go back, and this really seems to be a story around Fed rate expectations. Even going back to like 2022, 2024, we got the COVID stimulus. This thing rockets up to 2K, find some sellers, and it takes years for it to finally break above 2024. Coming into the year, I went over some of these dynamics in dollar yen. It's a similar story in gold, where it was in December of 2024 when the Fed starts talking up the idea of rate cuts. And at the time, inflation was still way too high to even be entertaining that. But, the Fed had other concerns. I think their big concern that they didn't want to say was regional banks. But, because if you're the Fed and you say, oh, there's a problem in regional banks need lower rates. Well, automatically you're going to cause a run on regional banks, right? So you can't quite say that explicitly. But, they were obviously leaning for lower rates, even with inflation remaining well above target. And so we get into December, Fed starts forecasting rate cuts in 23. Gold pops above 2K and really doesn't go below it at all until February. And what happened in February was an above expected CPI print, dashing hopes that, hey, maybe the Fed's not going to be able to cut this year. So it was like one day where there was like a little freak out. Gold goes below 2K, dollar rallies, stocks sell off. Day later, Austin Goolsbee, Chicago Fed. Let's not get all flipped out about one data print. It wasn't one data print. It was a few that had been above expected, but gold goes vertical and just continues to do so. And that's pretty much been its nature for the past 2.5 years. It finally found some change earlier this year. There was like a combination of factors that drove this, where you had an overbought move, without a doubt. But then you also started to have, kind of the sneaking factor of inflation. And then in March, when the Iran war hit, you have higher oil prices bringing on the threat of even more inflation. Now, there was a reason for some of those gold longs to close up, which is precisely what they did. But this is, I think, one of the reasons the technical analysis is so valuable. It helps to read through a lot of the noise. Where, sure, it was a strong pullback that lasted for like 6 months, but once it got down to this 4K level, the test below 4K continually bought in buyers until eventually the tides could begin to shift. And, go back to 2 weeks ago, Fed rate decision. Fed obviously sounds as though they don't want to be hiking rates, even though markets are pricing that in. And BOJ goes in to essentially light cash on fire with an intervention. Interventions aren't good uses of finite capital reserves. But it's the same story that we've had, where these central banks just want to lean on low rates as much as they can until they absolutely cannot. And I think that's one of the reasons that this story, that the story that we had around BOJ rate hikes, I think that's why it was unexciting to markets, because inflation's at 1.7%. You hike rates, and let's say it goes down, you're gonna hike again at 1.5. You're gonna hike again when CPI is at 1.2. What's the lifeline of that? Is it anything more than a 25 bip hike? I think that's why markets kind of shrug that off. But you'll notice that in gold, it got a major break, a major run here on the NFP report. A bad NFP report out of the U.S. last Friday, and that got us up to this 43.80 zone. And then this morning, another bad print with retail sales. Same thing. We had a pullback. We had a bearish engulf finish on the daily. We had that pullback continue all the way down to 43.05 or just above 43.05. And the response, and you can see this on the 30, is 8:30 this morning, right there, right around that retail sales print. That's what ultimately compelled price to jump back into that breakout zone. And so, after the pullback to support, bulls have been coming back in a very big way. And at this point, if we look at this on the weekly, the deeper it gets into that resistance zone, the more this is going to look like it's primed for bullish continuation. So a way to look away from a lot of these dollar themes, a lot of these USD themes that all invariably appear to be tied into dollar yen, but this is one that I still think is of interest for those greater overall macro themes. Okay, last most certainly not least, want to look at stocks. And again, did a video for StoneX on this yesterday. I think that this is an AI bubble, but I've also thought that for 2 years while remaining long and bullish. I don't think you have to trade your view. You don't have to trade your opinion. You're either a trader or an activist. And if you're a trader, that means you could divorce reality from your feelings. What I think ultimately could be the undoing of this is treasury rates, which isn't really a factor now, but could certainly become one in the next 12 months with all of the debt that's coming due in the US. There's a maturity wall hitting. So the Fed's going to, or the Treasury Department's going to have to auction off a ton of debt, which I think is going to lead to higher yields. And you get, a 30-year at 6%, a 30-year at 6.5% or 7%. And, now all of a sudden when we get a pullback, there's an option. You don't have to just chase overbought tech stocks. Okay, well, maybe I'll buy a 30-year Treasury with a 7% yield, and if rates do go down, then the principal value on that bond goes up, so I get a nice little investment. If they don't, I just clip 7% for 30 years and laugh my way to the bank. That's what we haven't had. But for now, I think these dips or these pullbacks are opportunistic, and we clearly have extension this week. You look at the way that this traded again. There's a bad is good kind of vibe still going on here, right? And this morning included retail sales. It was abysmal, yet here we are right at fresh highs in SPX. All this to mean there is a pretty big zone right down here. It was resistance over a couple of different occasions, right? Like 7582, 7600. If we get a pullback into that, that becomes, I think, a pretty attractive area to look for support to play. Don't expect it to be perfect. It's something like this that had shown up a couple of weeks ago that I think is most provocative. Either you see bulls step in before a test of that exact low that highlights a degree of anticipation, or you look for some degree of capitulation that shows sellers taking their shot and then failing as bulls come in to offset them. But expecting like a perfect kiss off support is a little too idealistic to be realistic in the long term. And last most certainly not least, this is the one, and if you watch that video that I did on StoneX, this is the one that ultimately I think puts everything together. Anybody that's learned markets in the last, say, 15 to 20 years, I think he has a hard time giving credence to just how important this is. But when I was learning markets, you could still get an 8% yield on a treasury, right? And I remember even at the time, it seemed somewhat unattractive at 7 or 8% because tech stocks were ripping. Where that does start to become more attractive is like right in here when you have a 6.5% 30-year yield and then tech stocks take a dip. And it's like, all right, maybe I don't want to chase that 15th dip in stocks, and instead I'll just lock it up in treasuries. And then as rates go down, prices go up, you get a nice little principal pop in that bond. Pretty attractive place to be. But what we haven't had since the financial collapse is a strong rate backdrop. You can see what happened in the financial collapse where 30s just go upside down. We got down to a low of just above 2.5. And with the Fed at a 2% inflation target and inflation running higher than that in some cases, you're looking at like close to 0 to 0.5% real rates on 30s. So going out a lot on the maturity curve. But the picture's changing. Now, this isn't something that's got to be lockstep, right? Because it's not like as soon as we get above 5.5%, all of a sudden there's going to be an exodus from stocks and into treasuries. It's more relational. Where if you're a bond desk right now and you look at the issuance that the U.S. has over the next 12 months, it's like, well, if I'm holding these 30s and the U.S. is going to issue more 30s and there's more supply and lower prices and higher yields, I'm basically putting my neck into the guillotine. So that could precipitate more selling. This is one of the reasons the Besant was so active with that Japanese yen intervention. He didn't want to fight the tides of more selling in these longer dated U.S. treasuries. And you look at 10s, which are the benchmark, and You know, there's actually a good example here where it was pretty responsive. We had one day in the last 17 years and 19 years, I think, actually, where treasuries were 10-year treasuries, 17, 19, technically, where 10-year treasuries yielded above 5%. One day. And when you see something like this, right there is October 23rd, 2023, one day where treasuries, 10-year treasuries had a 5% yield. One day. What happened there? Well, they get above 5%, and yeah, maybe they go higher, but if you got the chance to lock in 5% for 10 years, pretty attractive. But the bigger trade is, well, what if rates go down, as they did? They went down to 4% over the next couple of months. Now you got a bond with a premium behind it. You've essentially made a capital gain in a bond investment, and now you have optionality. You can hold on to that 5% coupon, or you could sell it at a premium. Pretty attractive place to be. Right now, you want to guess what was happening in stocks at the time? Again, that was the morning of Monday, October 23rd. Look at SPX. Monday, October 23rd. Right here. That Friday, we set a low, and that was a significant swing low, right? So you had that initial rush of weakness in equities as capital was coming out to buy treasuries. But then it got to a point where it wasn't that attractive again, and then you see stocks just ramp, and they continued to. We never took that low out, you know, even through, you know, multiple waves of fear ever since. So, you know, again, this isn't something that I expect to be in play for right now, but it is something that I think will take a toll over the next 12 months, given all the treasury issuance that is going to be hitting markets. But that, my friends, is what I have for this week. I want to thank everybody very much for your time this week. Mr. Boutros will be back with you next week, and I wish you all well, happy trading, and hope you have great weekends ahead. Thank you, folks.